Welcome to another live stream. Today, we're going to be reacting to ARK Innovation, the quarterly webinar. If you don't know what ARK Invest is, they've been disrupting the investing scene because their CEO, Cathie Wood, along with the analysts, a part of their team, basically had foresight based on research to understand, hey, Tesla is going to be huge. And so far, they've been right. And recently, ever since their Tesla prediction, they've gained fame, popularity, and respect. And as a investor and believer in their philosophy of investing in disruptive innovation, we're gonna react to this webinar, which should have started just now. But in the meantime, I'm gonna make sure that my live stream is actually live streaming. You know what I mean? You know what I'm saying? I don't want to mess anything up, y'all. Is my audio good? Can y'all hear me? Can y'all see me? You probably can, right? You can see me. Let's go. Excellent. Yo, Cathie Wood, you're late. What's going on? Quarterly webinar. Oh.
Q&A chat box at the bottom of your screen. As a reminder, today's call is being recorded. The information provided is for informational purposes only and does not constitute an offer, solicitation, or recommendation regarding any investment product or service. Any reference is not an endorsement by ARK, nor a recommendation by ARK to buy, sell, or hold. Participants should determine for themselves whether a particular service or product is suitable for their investment needs or should seek professional advice for their particular situation. Certain statements on today's call may be statements of future expectations or other forward-looking statements based on ARK's current views and assumptions and involve both known and unknown risks, uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied. ARK does not assume any obligation to update forward-looking information, and all information discussed today is subject to change without notice. In addition, certain information was obtained from sources that ARK believes to be reliable. However,
Basically, what they're saying right now is they don't want to get sued.
Now, on today's call, we will have ARK CEO and CIO, Cathie Wood, provide our quarterly commentary on the markets. Next, we will have ARK's research analysts provide a performance and portfolio composition review of each of ARK's 8 ETFs. And then finally, we'll wrap up with a Q&A session with ARK's research and investment team. Again, please use either the Q&A chat box. Please use the Q&A chat box at the bottom of your screen to ask any questions. So with that, I will turn it over to ARK CEO and CIO, Cathie Wood.
Okay, Ren, thank you very much. And thank you everyone on the line for joining us today. Before I start my commentaries, I'd like to introduce you all to 3 new analysts. They joined us within the last 6 weeks, and we'd like them to introduce themselves to you. So we've got Will Summerlin, who has joined us as our artificial intelligence expert on the next generation internet team. Nishita Jain, who has joined our fintech team, and Frank Downing, who has joined, both fintech and next generation internet. He'll have responsibilities having to do with both. So Will, would you like to introduce yourself?
I'd love to. Thanks, Cathie. So as mentioned, I'm focused on artificial intelligence at ARK. I've been here since the beginning of March. Prior to ARK, I was at Lyft, where I was working on product. Before Lyft, I was working with growth stage startups and venture capital firms on strategy, product, and mergers and acquisitions. And before that, I was building a startup. So I spent 4 years building a startup in the artificial intelligence space, raised a few venture capital rounds, and then eventually sold that company. So excited to be here.
Nishita?
Yeah, thank you so much, Cathie. So hi, everyone. My name is Nishita, and I recently joined ARK as an associate within the fintech strategy. In terms of my background, I graduated from the University of Pennsylvania just recently, where I studied computer science and business. During my time there, I focused on a blend of software engineering, consulting, and venture capital. And so I'm super excited to be a part of the ARK team. Thank you.
Thanks, Nishida. Frank?
Thanks, Cathie. So this is actually my first week at ARK, and I couldn't be more thrilled to be joining the ARK team at such an exciting period of time. As Cathie mentioned, I'll be covering cloud computing, how that technology plays in across both our internet and fintech strategies. I'm coming to ARK from Deloitte's cloud engineering practice, where I worked both in the weeds at a software development and data engineering level, and also at higher technology strategy levels, serving clients of varying sizes, ranging from pre-IPO to hyperscaler. Now I can't wait to bring that boots on the ground experience to help drive research and investment at ARK.
Thanks, Frank. Okay, now on to the commentary. I'm going to make this brief because we did do a market update earlier this week, so you should take a look at that if you'd like more detail. But the summary here is that the equity markets faced two very big tests during the first quarter. One was a near doubling in long-term interest rates. The long-term treasury yield moved from 90 basis points to 175 basis points within one quarter. And I describe that movement in the bond market as a heart attack for the bond market. And to be honest, while it did give the equity market some pause, and certainly the higher valuation end of the markets were hit, including our strategies, I think the market ended up migrating through that period very well. In fact, the equity market, the broad-based equity market, was up. One of the interesting things we learned as we were trying to figure out why this move was taking place in such a short period of time, again, very, very unusual for the bond market, the treasury yield. We learned more about capital ratios at banks that were going to tighten up again. During the coronavirus last year, the Fed gave the banks some leniency in terms of what they could apply to their capital ratios. And they were going to be able to use bonds, treasury bonds, which were, of course, higher yielding than cash. And that leniency ended on March 31st. So one of the things that may have happened here is that the banks were, who had perhaps expected an extension, given all the concerns about relapse and the coronavirus, and still the difficulties that some parts of the economy have. Well, there was a political dynamic that essentially a number of politicians said, no more leniency for the banks, ended on March 31st. And so banks had to probably sell treasury bonds. We think that explains what happened more than fears of inflation. We know the base effect is here. We are now comparing against price collapses last year. And it does seem like the CPI inflation rate could move into the 3 to 4% range before this is all over, let's say by mid-year. And the PPI inflation rate could increase to 6 to 8%. The Fed knows this and has commented on it, anticipated it, and has said it will not react to it because it is temporary. It is a function of more of what happened last year than what is happening this year. Nonetheless, there is an inflation debate out there. We don't think that's the only reason interest rates went up. It was this capital ratio phenomenon that I just described. And one of the proof points for that is today. Today we got retail sales up 9.8%. Expectations were 5.8%. And the bond market rallied. So I think that threw a lot of people off. So it seems that this reason may have some staying power. The second challenge the equity markets faced during the second quarter was the Archegos debacle. And it was simply too much leverage and too concentrated, perhaps. Now, what could have happened coming off of that is a domino effect where prime brokers and banks generally pulled back on risk, and we could have had a cascading effect. That didn't happen, and it probably means that the controls, risk controls put in place after 0809 are really working for the most part. So the equity markets ended up, that was very good news, and they broadened out. So the top performing sectors were energy, number one, it was up somewhere in the mid 20% range, and financials up somewhere, these are not exact, in the mid-teens range. And so that's good news. The bull market is broadening out. We have faced this kind of period before when our strategy is under pressure relative to a rotation into value and more cyclical strategies. This was in the fourth quarter of 2016 when President Trump, against all expectations, was elected, and the markets took off, especially value and cyclical. We were negative in that quarter. And I remember saying at the time, this is not bad news. This is very good news. The bull market is broadening out, which is a healthy sign. What would be unhealthy is to see the bull market narrowing increasingly towards something like our strategies, innovation strategies. So we feel like the equity markets are on solid footing, and we do believe that this broadening out will serve as a launching pad for the next leg of our move up in this market. We do have to deal with the base effect in here. I think the market's dealing with that well. And if anything, as we have stated many times, we do believe that the risk out there is not inflation, it is deflation. And it's a risk on the one hand when we're talking about bad deflation, companies who have leveraged up to buy back shares and pay dividends, satisfy short-term oriented shareholders, and that did not invest enough in innovation. We're probably going to see the sunsetting of a lot of those companies, certainly in terms of losing market share, if not the companies themselves. There's another source of deflation underway, we believe, that is good deflation. Good deflation is associated with innovation and the cost declines associated with technologically enabled innovation. We've mentioned many times the cost declines. I'll just give you a few of the more dramatic ones. And we have centered our research on something called Wright's Law to identify these cost declines and measure them. Wright's Law says for every cumulative doubling in the number of units produced, costs decline at a consistent percentage rate. For short read DNA sequencing, that's 40%. 40% declines for every cumulative doubling in units. And we're a very low base in terms of the number of whole human genome sequenced. In the industrial robotics space, it's 28%, and in the battery space, it's roughly 28%. So these are very rapid cost declines as new technologies are scaling and really transforming the way the world works, and bringing with them a good deflation. This will take the sting out of the 27% increase in M2 growth we've seen on a year-over-year basis, because what deflation does is it causes a deferral of activity. And just to give you a sense of that, I'll use the flip side. I started in the business in the 70s, late 70s, when inflation was raging. And back then, many consumers and businesses were making decisions, speeding up decisions to avoid higher prices and higher interest rates. that was accelerating or increasing the velocity of money. And that in turn became a negative feedback loop, causing further inflation. We think the opposite is going on now, that sure, we'll have early adopters of these technologies, but there will also be consumers and businesses that delay adoption, waiting for lower costs or lower prices. And that will cause a decline in the velocity of money. I think many who did not experience the velocity increases of the 70s can appreciate the power of velocity when it comes to inflation or deflation. So we're very much more focused on deflation after we get through this base effect. So with that, we'd like to go on to the fund performance. We'll start with the Autonomous Technology and Robotics ETF, ARKQ. So Tasha Tasha and Sam will take us through that. Tasha?
Thanks, Cathie. You'll notice here one of the top contributors, for the quarter was Deere. So Deere benefited from a couple things. So first, it's a company that could benefit from the infrastructure bill. So there was some excitement around that. Deere also had a better than expected quarter. This was mainly driven by improvements in agriculture and construction broadly. I'll say that one of the reasons that we own this company is because they are very focused on autonomy. We think autonomous technology could touch all areas of machines and mobility. So, that includes ag and construction. And Deere, I'd say for the past few earnings calls, you can hear that management is just increasingly focused on this. This past one they mentioned, they believe they're getting closer and closer to full autonomy. Of course, if they're successful, they could benefit from the install base that they have to leverage that in terms of becoming a leader in this space. And then on the detractor side, you'll see Baidu here. Cathie mentioned this was affected by the Archegos forced selling in the quarter, as well as general fears of potentially Chinese ADRs delisting and a potential collaboration with the Chinese, or a potential effort of the Chinese government to join with an internet company there. Why this company is in the portfolio? Well, Baidu's Project Apollo is one of the more aggressive autonomous efforts in China. They've done quite a bit of testing compared to peers, so they're actually getting cars on the road in many cities. Over this past year, we've seen that effort expand quite a bit in terms of geography. They're also working with the government in terms of getting sensors into infrastructure for autonomy. And while that's not at the core of our thesis, they're sort of they're working with city officials to do so, which could definitely be advantageous for launching an autonomous taxi network. And now I'll pass it off to Sam.
Thank you, Tasha. Virgin Galactic Holdings was another one of our top contributors for the quarter. And Virgin Galactic appreciated after announcing plans to conduct a key test flight that would lead to them doing a commercial flight later in the quarter. But then it retraced a lot of those gains after delaying the flight. And then towards the end of the quarter, they unveiled its new Spaceship 3, which is more modularly built. And so they're really trying to ramp up production there and bring costs down as they continue to focus to get this first commercial flight off the ground. And we'll go into the longer term opportunity with hypersonic point-to-point travel later on. But we think that's the real long-term potential for Virgin Galactic. On the detractor side, we had Experience Investment Corporation. And this is a SPAC that is planning to merge with Blade Air Mobility. And so you can kind of think of them as Uber for air taxis. And currently they utilize helicopters, but they've already signed agreements and are working to incorporate electric vertical takeoff and landing aircraft as they enter production. And they kind of were hit by a rotation away from SPACs in general. And this was despite them reporting an impressive first quarter, which suggested that air travel is going to pick up faster than many people anticipated. And I think we're already starting to see that, so that we should see that in their performance as we go forward. With that, I'm going to hand it back to Cathie to talk about some of the portfolio characteristics.
Sure. And before I do that, I should mention that ARKQ and PRNT were the two big performers for us this quarter. Now, we tend not to look at the world quarter by quarter, but we know that many investors do. So we provide those numbers for you here. So you can see up roughly 10% compared to roughly 6% for the S&P 5% and 5% for MSCI World. You can also see, if you look at the longer term, our focus is a 5-year time horizon. And so that's more, we're very pleased with the results over the past 5 years and very excited about the future of this space for the next 5 years. So on to characteristics. For those of you who are not as familiar with the way with ARK's research and investment processes, what you'll see here is a concentrated portfolio, roughly 50% of the stocks in the top 10. You'll see a good smattering of stocks across the cap spectrum, from mega to small. And one of the reasons the market caps for many of our funds have moved up in terms of the categories here is because of the performance. Last year was a very big year and added a lot of capitalization to our different funds. You can see sectors on the bottom right there. This is not how we think about the world. In fact, we think the lines between and among sectors are blurring because technology is permeating every sector. And I used to say our stocks fall through the cracks, but really the right way of saying that, as our world is evolving and we're understanding it more and more, is that sectors and innovation platforms are converging. There's a major convergence taking place right now between and among sectors and technologies, making research in terms of the traditional way that it has been set up in a very siloed and specialized way, making research done that way very difficult. We've set up our research department so that our analysts are specialists not in sectors or industries or sub-industries, but in technologies that cut across sectors. So they would be more generalist when it comes to sectors, perhaps with the exception of healthcare, of course. And then you can see how we do look at our portfolio. We look at the portfolio by technology platform and or platforms and enabling technologies. So you can see the top concentrations in ARKQ are autonomous vehicles, robotics, and energy storage. And when I think about it, autonomous taxi networks is probably one of the best examples of the convergence I just described. Autonomous taxi networks autonomous vehicles are robots. They will be electric, because that is going to already electric total cost of ownership is much lower than gas-powered vehicles. And artificial intelligence, they will be powered by artificial intelligence. So, and just in terms of stocks themselves, you'll see Tesla here. We get a lot of questions, so I'll anticipate them about our activity in Tesla, given our price targets. As you may know, Tasha and Sam put out our model on Tesla. It's on GitHub now. You can play around with the variables if you'd like to battle test the model. And you'll see that our base case assumption is $3,000 in 5 years. The stock is a little over $700 right now. So we see quite a big increase during the next 5 years. Why would we ever sell this stock? Well, we get opportunities like we did in the first quarter, where Tesla touched nearly $900, and then during the volatility, I wouldn't call it crisis. For us, it was an opportunity. But during what some are calling the crisis, the volatility crisis, it dropped into the low 300 range. I mean, 500 range, sorry. So from 900 to the low 500. And we were buying aggressively as it did that, back up to 10%, which is as high as we can buy it. We can then let it run, and we usually let it run to roughly 11, 12, 13% of a portfolio, at which point it has appreciated relative to the portfolio by roughly 10 to 30%. And so if another name is trying to find its way into the portfolio and we need the cash, we will be opportunistic with a stock like Tesla, which is so volatile. So with that, we'll go to the next page and the next portfolio, the next generation internet ETF, ARKW, and we'll start this off with Yassine, and then go to Nick and Yulong.
Thank you, Cathie. So our largest contributor in ARKW was the Grayscale Bitcoin Investment Trust, GBTC, which is a trust that tracks Bitcoin's underlying price. So GBTC contributed 199 basis points to overall performance, and it's earned its way up to the second largest position in the fund. As of the end of the first quarter, it stands at about a 5.8% position. So this quarter saw Bitcoin's price surge to new all-time highs, surpassing a $1 trillion market cap for the first time. It started the quarter trading around $30,000 and ended the quarter up nearly 100%, trading at $60,000. The price increase was supported by really continued institutional validation, most notably following Square and MicroStrategy's announcement of balance sheet investments in Bitcoin. Tesla also announced a $1.5 billion investment in Bitcoin. It's also begun accepting Bitcoin as a payment method for its products, a decision that appears to really be legitimizing the pivotal role Bitcoin is playing in the economy. Other notable catalysts include PayPal, allowing its US users to spend their crypto holdings at millions of online merchants globally. We had announcements from Morgan Stanley and Goldman Sachs, who both filed to offer Bitcoin exposure through multiple investment vehicles. And finally, Visa announced that it's now settling payments in the USDC stablecoin on the Ethereum blockchain. So the momentum that we saw at the end of 2020 really seems to have set this quarter up quite nicely. And now with recent developments into quarter two, including the Coinbase public listing, I think the momentum will kind of continue to increase from there. I also want to briefly address our thoughts on the GBTC discount, which last quarter traded down to a 14% discount and then continued to trade at a discount through the end of the quarter. It appears the discount is largely a function of the increased competition we're seeing. Canada recently approved a Bitcoin ETF that now trades at NAV, and while the US has yet to approve one, I suspect we'll get an ETF approval eventually, especially now that Gary Gensler is head of the SEC. So this leaves Grayscale at a really interesting crossroads. I think in the short term, it appears that Grayscale is doing everything that they can to alleviate this discount. They announced this quarter that they would be doing a $250 million share buyback to try to alleviate that discount, but even that has appeared insufficient to push it back above NAV. Historically, another alternative would have been for Grayscale to issue additional shares via private placement to more closely match NAV. But given the discount, accredited investors have no incentive to participate because there's no longer an arbitrage to play between a premium and NAV. You have the annual 2% fee compared to ETF alternatives that's also higher than average, which is probably putting them at a further disadvantage. So it seems that the ultimate solution for Grayscale and GBTC holders is going to be a conversion of GBTC into an ETF that would then trade at NAV. And Grayscale recently published a blog reinforcing their commitment to converting GBTC into an ETF, and I suspect that's likely the outcome here. So, we're definitely, as relatively large holders, keeping a close eye on how the dynamics are going to play out. With that, I'll hand it off to you, Long, to discuss AGI.
Thanks, Yassine. So I'm going to talk about Agora API briefly. So this is a platform as a service company that enables real-time communication on many-to-many large-scale basis. The company is a real key enabler in some of the largest online edtech companies, streaming companies, as well as game companies across the world, but predominantly in China. And the company really gotten a lot of traction, we believe, throughout this quarter, especially in the first half, due to reportedly its enabling of a popular app, Clubhouse. And as some of you may have heard, Clubhouse really took off in terms of engagement from tens of thousands of users as recently as Q3 of last year to several million users. As part of that, people were doing potential math on incremental revenue of what this might mean to Agora. And as a result, the stock went from roughly $40 to over $100 just in a matter of a month and a half. And we've certainly taken advantage of some of this rapid rise in the stock price and taking profits. And on the back half of the quarter, the company has reported, and the one of the potential disappointment came with the report as a guidance for 2021, and the implied growth rate likely disappointed relative to the expectations, especially given the Clubhouse's success. And the reason why we still own this stock and we like Agora here is ultimately this is an enabler of a critical feature that really plugs into multiple long-term digital themes that we like across metaverse in online education, as well as many other newer verticals, even including finance, online healthcare, and so forth. So yes, with that, I will turn it off to Nick.
Thanks, Yulong. I'm going to focus on the detractor side and talk about both Unity and Spotify. Starting with Unity. So Unity detracted from performance this quarter after it disclosed that Apple's IDFA changes will impact its revenues going forward by roughly 3%. So while Unity is known for its game engine, it's also important to state that it runs a large mobile ad network because of the number of Unity-based apps that have adopted its advertising solution. And just taking a step back, Apple's new privacy policy change around IDFA, which stands for ID for advertisers, will give users the option to share or not share that ID. If enough of Apple's users opt out of sharing their ad idea, it could negatively impact advertisers and companies that operate in this space, like Unity. Even though Unity and many others have come out and given guidance around IDFA and its potential impact on revenue, it remains largely unknown because of there is no precedent for an event like this within data privacy. So, while Unity has given this metric and many other companies, Facebook, is a great example here. It is the uncertainty that is weighing on all of the stocks with exposure to advertising and IDFA, because it could be the case that less users opt out than most analysts and companies were expecting, and in which case you could have less of an impact across the board. In the other scenario, you could have a larger amount of users opt out. So again, it really comes back to this uncertainty around IDFA, and we should get more answers as IDFA launches within the next couple of weeks. That seems to be the rumors. Apple's going to be rolling this out in the next couple of weeks after having delayed it for a number of months. This was actually originally supposed to roll out in September. The other name we want to highlight is Spotify. So Spotify traded down in the quarter after posting a wider than expected loss in the fourth quarter of 2020. That being said, the company reported strong year-over-year user growth of around 27% in the fourth quarter, bringing their total monthly active users to 345 million. And just focusing on Spotify, I think it's important, as we've been following this company, and it's become very clear that the company has much larger ambitions than just music streaming. This primarily focusing around podcasting and live audio. And we believe, podcasting is starting to drive some of that higher user growth. And live audio could be another call option here. So in this quarter, Spotify went out and acquired a company called Locker Room that functions very much in the same way as Clubhouse, which Yulong just had mentioned, in the live audio space, but has specifically focused on sports. Spotify actually plans they've acquired Locker Room, and now they plan to open it up and give their musicians and creators a new platform to engage with their audience. So when we think of Spotify going forward, it's not just music streaming. So when you compare it head to head with some of the other services out there, it's really important to start framing it as an audio platform, and that's inclusive of all new different types of audio. So with that, I would like to hand it back over to Cathie.
Okay, Nick, thank you. The only thing I'll focus on here in terms of performance, and again, we are not quarterly oriented. Our time horizon is 5 years. But many advisors,
Bro, my camera died.
Consultants think that there's a very high correlation between the performance of the various strategies that we run. And you can see the difference between ARKQ and ARKW, quite a big difference this year. And Q probably is the most differentiated of the strategies in terms of it has much more of a cyclical bias to it, because many of the transportation autonomous ideas are more cyclical. So just wanted to highlight that. In terms of the characteristics of the portfolio, you can see those here again. I won't go through anything in particular, not wanting to repeat what I said just a bit earlier, but what is notable in this portfolio is you do not see any FANG stock in the top 10 of this portfolio. We do own them in a part of the portfolio, but we are in search for the next FANGs that will have performance characteristics more like the FANGs have had during the last 10 years than they will have during the next 10 years. So with that, we can then go on to the next strategy, the Genomic Revolution ETF, ARKG, and we can start with Simon and then Ali.
Thanks, Cathie. So first, I'll start with our largest contributor for the quarter, Pacific Biosciences of California, or PacBio. So PacBio in the first quarter, I think, really advanced for a handful of reasons, mostly owing to some pretty major developments in both technology as well as business development. And before I get to that, I'll just kind of quickly mention another reason we felt really pushed the stock forward quite a bit over the quarter, which was a fairly transformational $900 million investment from SoftBank, which we think does a few things for PacBio. So first of all, with that amount of money on the balance sheet, we think that it certainly helps to lock in the time frame of product development. I think it allows more flexibility in terms of organic and inorganic growth to kind of help build out a multi-product portfolio, which the company has been very transparent about trying to scale up its sequencing hardware as well as scale it down and meet customers at whatever level of throughput and sequencing intensity that they may need. So in addition to that, I think I'll maybe point out a handful of business developments in the quarter. So the UK-based Sanger Institute more than doubled its install base of PacBio's Sequel IIe instrument, which is their newest flagship long-read sequencer. So this was done to help support the Darwin Tree of Life research initiative, which is essentially a research initiative to sequence many different plant species and animal species in the UK and build out our knowledge of those evolutionary lineages. In addition to that, Children's Mercy Hospital in Kansas City, one of the leading US children's hospitals, actually tripled its investment in the Sequel IIe to help fund studies to help diagnose children that have these rare genetic conditions. In addition to this, PacBio actually sort of meaningfully expanded its management team, both on the vice president and the C-suite level. They hired both Mark Van Owen and Peter Froman, who are Illumina alumni. So Mark is going to take over as PacBio's chief operating officer and Peter as PacBio's chief commercial officer. And then I think the last thing to really touch in on is the announcement of a multi-year product partnership between Invitae and PacBio to help develop an ultra high throughput sequencing platform, which should enable, we think in the shorter term, Invitae to actually migrate a substantial or even a majority of its sequencing cluster to PacBio's HiFi technology, which in our view provides the most accurate and complete view of the genome. And we just want to note here that PacBio is free to broadly commercialize the results or the products that are built out from this collaboration to other customers. And then I'll just quickly move over and talk about Teladoc, which was one of the detractors in the quarter. So, despite printing an exceptionally strong, I think, fiscal 2020, we think that Teladoc detracted for a handful of reasons. I think one of the first ones to point out is there was a lot of enthusiasm and excitement, I think, in the broader digital and virtual healthcare spaces. Some of this is definitely due to a lot of competitive noise from, really large companies like Amazon taking a stab at the healthcare space, as well as some other SPACs and IPOs. I'll mention a few, maybe like Talkspace and Hims and Hers. As well as some others that are coming online, and we think, kind of potentially obscuring where Teladoc fits in from a competitive standpoint. And, I think especially when it comes to Amazon, because I remember this was a conversation that came up at the time, which is that the healthcare ecosystem is, really entrenched in relationships and very difficult to navigate regulatory environments that are not easily teased apart with high capital budgets or technology. So it's a little bit different of a space than some others. I think in addition to that, the speed of the U.S. vaccination efforts, may have sort of reinforced this going stay-at-home narrative around Teladoc. Namely that an increase in-person healthcare visits would kind of curb Teladoc's growth. And so, to maybe reset a little bit here, we think that, virtual care, digital healthcare, and, the ability to navigate between brick and mortar and virtual care is a secular trend that is really here to stay, and that was, kind of broadly accelerated by the pandemic. And we think that, Teladoc has a definitive advantage in both its data science capabilities, especially after the acquisition of Livongo, and its platform comprehensiveness that touches on, in-hospital sort of enterprise-face relationships, as well as acute and ambulatory, and even kind of behavioral and outpatient centers. And we think that this ecosystem is certainly one of Teladoc's unique characteristics in the space. And so with that, I'll just quickly turn it over to Ali to talk about a handful of other names within the genomic portfolio.
Thanks, Simon. So to begin, I'm going to start with one of the top contributors, which is Intellia Therapeutics. So we think that they were a top contributor for a number of reasons this quarter. So I'll just go through a couple of them. One is Bluebird Bio actually determined that its sickle cell gene therapy was likely not the cause of a patient's acute myeloid leukemia diagnosis, which generally just caused a rally for the gene editing stocks. Additionally, Intellia also presented some interesting data this quarter. So they had some promising preclinical data at the Keystone E-Symposium, and that data was on in vivo CRISPR editing of the bone marrow. They also presented some new data on its expanded base editing capabilities. That will help with multiplex editing, meaning doing multiple edits at the same time, as opposed to doing sequential edits ex vivo, which takes longer. And if a patient's waiting for a therapy, that could be really important. So we really believe that Intellia is positioned to be, a leader in the genome editing space. And it continues to advance its science in multiple modalities, as mentioned, including one that excites us a lot, which is in vivo gene editing. Moving over to the detractor side, Iovance depreciated this quarter. We think that it's potentially because investors may be worried about sort of this ongoing debate that they're having with the FDA or the US Food and Drug Administration, and that's about the potency assays for its candidate lifileucel, which is a tumor-infiltrating lymphocyte cancer therapeutic. So basically, you take out the tumor, you excise it to get these cancer, fighting engineered cells, and you put it back into the body. This debate has actually delayed the BLA submission, which is a biologics licensing application, which is essentially an FDA application that is a request from the company to commercialize a product. So Iovance really continues to be a leader in the solid tumor cancer therapeutics, and the company has some of the most compelling data, in our opinion, in melanoma and lung cancer. And with that, I'll pass it back to Cathie to discuss some more of the funds.
Okay, thank you, Ali. And just on the next page, I just want to point out one thing. As the bull market in genomics took off last year, we did what we always do, and that is we diversified the portfolio into what we call them cash-like holdings that will hold up well in a correction. And but we did it this time for another reason as well. As we are learning about the convergence between and among DNA sequencing, artificial intelligence, gene editing, and other gene therapies, we are beginning to discern which of the larger biotech companies out there are embracing these technologies and running hard with them. And those were the names that into which we diversified as the massive rally last year in biotech took place. These stocks are value stocks, and that's unusual in our portfolio. But I think they're value stocks because the traditional healthcare analyst out there is not as focused as we are on this convergence of technologies, and probably doesn't understand how profoundly this convergence will change the return on R&D investment for those companies embracing these technologies. So we think Regeneron, Novartis, Vertex, Takeda, and Roche are among them. During the volatility crisis or opportunity this last quarter, we did sell some of these names and move into names that were being hit hard. These were not hit hard. They're value stocks. They seem to be steady eddies. And we noticed that those moves were getting a lot of attention in the marketplace. Many commentators saying, wow, they're selling their liquid stocks and buying illiquid. This is what we always do during a crisis, because a crisis usually takes the less liquid stocks down more. So this is not unusual for us. It's de rigueur, and the comparisons to other companies that were trapped when they had no more liquid stocks to sell, and had to shut down were completely off base. So if anything, we've held on to these stocks in terms of sizing the positions to a higher level, or we've held on longer because we see the opportunity for returns on R&D investment to go, this is going to be industry average, from roughly 7% now back into the 20-30%, and in this case we think it could be higher than that, plus days of the 80s and 90s. So we think we're going back into the golden age of healthcare as these technologies converge and reduce the number of trial failures, as well as the time to market by 25% or more. So with that, we'll move on to the FinTech Innovation ETF, ARKF, and Max and Yulong.
Thank you, Cathie. First, Silvergate. Silvergate appreciated in the first quarter of 2021 on the back of a record price surge across the cryptocurrency market. And Yassine already touched on that in detail during his comments on GBTC. So I think you're going to keep that commentary on Silvergate light. Just overall, I would say we do believe in Silvergate's strategy, especially around the Silvergate Exchange network, with its strong network effects, in our opinion, that positions Silvergate not only as a facilitator, but also prime beneficiary of increased crypto adoption broadly. Secondly, Tinkoff Bank, you can see that as TCS Group Holding. Tinkoff is listed as TCS Group Holding, was a contributor as well in the first quarter of 2021, as Tinkoff, which is a Russian digital bank, we would say digital wallet, as its services really extend across a number of different financial, but also other commercial services. It truly is a digital wallet and super app. Continue to execute strongly in the fourth quarter and in the full year of 2020 overall, despite the COVID-19 pandemic. And that is especially significant as a lot of Tinkoff's business is in the consumer credit market. Tinkoff reached over 13 million total customers and over 9 million active customers. And that makes it the third largest bank and largest privately held bank in Russia. Also worth noting, the company's investment product has seen strong adoption in 2020 as well, with more than 60% of all active retail brokerage customers in Russia using Tinkoff's product. With that, I'll pass it over to you, Long.
Thank you, Max. So Opendoor was one of the top detractors in the fund this quarter. So Opendoor is a pioneer, is the pioneer in the managed marketplace for real estate, also known as iBuying. This was founded by Eric Wu back in 2014. And it's important to note the key difference between a managed marketplace versus a traditional marketplace, which is more similar to a listing services. In the managed marketplace, the platform tend to add a layer of services to the underlying merchandise being exchanged. And in this case, for real estate, what Opendoor does is it buys the home, it inspects the home, and fixes it up, and ultimately sells it off. So as you can imagine, as part of doing that process, it's more capital intensive. You're taking on potential inventory risk, and most importantly, it does have a layer of execution risk. It's more complicated, but nonetheless, we believe this model is potentially highly disruptive in this $1.7 trillion real estate market. that is antiquated and is ripe for digitization. And at scale, we believe Opendoor can be very profitable. It has already demonstrated strong unit economics in some of its core cohort markets. The reason why the stock underperformed in the quarter, we believe, were largely due to macro and non-company specific reasons. As a matter of fact, they reported very strong Q4 numbers, and Q1 guidance came in meaningfully above the consensus estimates. And the reason we think Opendoor may have sold off slightly more than Zillow or Redfin, two of its peers, is one is on this perceived risk around its business model. It's still in its nascency, well below 1% of the real estate residential real estate market. But nonetheless, we believe Opendoor is well positioned. We think one of the fears is around its cash burn level, especially when rates is going up. But Opendoor, with its latest round of financing, has pro forma cash balance of 2.3 billion, and it has been burning cash at roughly it's under 200 million per year type of rate. So we believe even as they expedite on the growth plan, they have ample runway in terms of balance sheet. And just in terms of this fear around rate hikes, historically, if rates go up very high, it does impair on home buyers' ability to take mortgage finance their homes. That said, as you have already heard from Cathie's remark in the beginning, we really don't think rates long term is going to a dangerous level. We think this deflationary force is really in play here. We believe Opendoor is well positioned as they execute. The stock will take care of itself. And the second company here is Z Holdings. They are known for one of its core assets, Yahoo Japan, which sounds like a very old name and maybe surprising to you guys, but it's in fact the most predominantly used search engines in Japan today. It also has a mobile payment app that's with 8 million plus active users today, as well as most recently it just merged with Line app, which is the equivalent of WeChat in China. The reason why Z Holdings sold off in March is on a report that one of their Chinese affiliates in Shanghai has had access to potential user data since 2018. And as part of that, the Japanese government has since temporarily halted their use in the Line app. While we believe this is something the company has to address and fix, we think this is temporary in nature. Line is in the core use of every day-to-day life activities amongst the Japanese users, and this should get resolved over time. The other very interesting development here is Z Holdings has announced to invest over $5 billion over the next 5 years into AI. And hiring AI talents and looking for ways to really develop this Line integration and its product development, not just in Japan, but in other markets as well. So with that, I'd like to turn it back to Cathie.
Okay, thank you, Yulong. And so on the next page, in the interest of time, I'll just focus on one thing from the chart. Under sectors, you'll see, yes, this is a fintech portfolio and technology features prominently. Financials, only 19%. And as you may know, if you read our research about digital wallets, we think traditional banks and traditional financial services are going to be disrupted and disintermediated quite significantly during this fintech innovation or fintech revolution. So with that, we'll go to the flagship portfolio. And we've talked about many of these stocks already. We figured we would feature just two here that we have not discussed already. So Tasha on Stratasys and Ali on Editas. Tasha?
Sure. So briefly on Stratasys, 3D printing manufacturer here. They were helped early on in the quarter. Peer 3D Systems had announced some preliminary revenue figures that were that had surpassed expectations. Stratasys also got some increased coverage from analysts this quarter. That was positive. And they also had better than expected quarterly results. In general, we heard in this past call that management is increasingly focused on software. They most recently acquired a couple new technologies, so we'll keep following that integration as 3D printing makes its move into more manufacturing applications. And now I'll pass it to Ali.
Thanks, Tasha. So just to discuss Editas. So Editas underperformed this quarter. We think there were a few reasons for it. So firstly, there was an announcement that its chief scientific officer, Charles Albright, was pursuing another opportunity. So just further management turnover. They've had some previous management turnover, so that may be concerning to some investors. The company also disclosed that its investigational new drug application for EDIT 301, which is their therapy for sickle cell disease, was cleared, but it's actually on partial hold for the efficacy portion of the trial because it needs to develop an improved potency assay. So what that means is that the data collected now could be used for safety, but not efficacy. We also believe that investors are patiently waiting for data on the company's LCA10 program or their ocular program to hear about potential signs of efficacy. However, I would say that we remain optimistic. They have a new CEO at the helm, James Mullen, and we believe that he's the right person to potentially take the pipeline further into the clinic, mainly focused on CRISPR-Cas12a and INK, or induced pluripotent stem cells with NK cells for solid tumors. And with that, I'll pass it back to Cathie.
Okay, thank you, Ali. I don't think we need to say much about the next page, except healthcare. If you're looking at this portfolio through a traditional sector lens, is the largest sector in the portfolio. You can see how we do think about the portfolio. We think about it in terms of exposure to the 5 platforms and 14 technologies involved in those platforms. Now we're going to go into our 2 self-indexed ETFs. Tasha will take you through both of them, and I think Ali will contribute to IZRL. So Tasha?
Thanks, Cathie. For the 3D printing ETF, our top contributor here for the quarter was 3D Systems. I mentioned they had some preliminary revenue figures. They actually lifted a lot of peers with that announcement early on in the quarter. In general, 3D printing has gotten a lot of increased attention, both as the use of 3D printing has been highlighted during the pandemic, and as we've seen more companies emerge and go public in the space. Interestingly, at the end of the quarter, a new 3D printing company to go public, Velo 3D, may have caused some competition fears, and Desktop Metal sold off a bit on that announcement. They both participate in metal 3D printing, but I will note that this is a technology that it's in the early days of adoption still. We think it's about 1% penetrated of the largest portion of the market and use parts. So new technologies are often for different applications applications than the technologies we have today. So it's exciting to see more companies enter the space from our perspective. Moving on to the composition of the ETF, you can see here this is, again, index-based. It's broken out into 3D printing hardware, software, services, service centers, scanning and measurement, and materials companies, with 3D printing hardware having the highest weight. You can see that this portfolio spans the market cap range here, sort of across large and small cap. And again, it's designed to capture the full ecosystem of 3D printing. Moving on to IZRL, this is our Israeli Innovation Index. I already spoke to the top contributor you see here, Stratasys. So I will pass it off to Simon to talk about NanoX imaging.
Thanks, Tasha. So just very quickly, we think that NanoX depreciated modestly in the first quarter, potentially because investors or speculators may have been spooked by a draft statement from the FDA that sought additional information on the company's flagship digital medical imaging system, which is called the NanoX ARK. So for some background, this is something that is fairly common medical device regulation. When the FDA seeks additional information like this, there are generally outstanding questions or concerns about an instrument as it's undergoing its approval process. So we think that is likely the source of the drawdown in the name over the quarter. And with that, I'll quickly turn it back to Tasha.
Thanks, Simon. Again, this is our Israeli Innovation Index. It's index-based. We chose a self-indexed structure for this because the space is relatively small today, but we see Israel as one of the innovation capitals of the world. There are many startups that are emerging there, relatively small today, all of our technologies. So we thought that this portfolio would be a way to build a well-diversified way to gain exposure to that very exciting, concentrated area of innovation.
Okay, and last but not least is our newest fund, the Space Exploration and Innovation ETF. Sam is going to take you through this, but we are really delighted that it has, I think it has the third best takeoff of any fund. And I'm not sure what the time period, it was either the first day or the first week. I think only the GLD and the S&P have done better. It is now approaching $700 million, a little over $650 million in assets. So Sam, take it away.
Thank you, Cathie. And yes, we're very excited about bringing this fund and the opportunity ahead for space exploration and innovation. And I'll just quickly walk through the portfolio composition you see here on the right side and describe how we think about it. And then I know there are lots of questions about specific holdings, so we'll touch on those briefly as well. And so when we're thinking about space broadly, we like to bucket it into orbital aerospace. And so those are companies that are launching and making satellites, operating satellite networks in outer space. And that's typically what people think of when you just say space, but the ecosystem is much broader than that. There's also suborbital aerospace, and this is the area with space tourism, potentially hypersonic point-to-point transportation, high altitude surveillance, and pseudo-satellite type aircraft. Then you have aerospace beneficiaries, and these are companies that benefit.
This is the most exciting part of the entire call, and unfortunately, I gotta go, y'all. I might react to this webinar in the future, but for now, I did not expect it to go this long. I apologize. I'm gonna comment down below where you can find it. And I already put it on the live stream actually. Boom, right there. So I hope you all found this informative, and I hope my notes were helpful. Oh man, this is the most exciting part. Space. Fuck. Hey, if you subscribe, you might catch me reacting to this part of the webinar. So, thank you so much for watching. Goodbye.